Good morning, everybody, and welcome. I'm Eric Schatzker, editor-at-large here at Bloomberg, and this is the year ahead. Before we begin, I just want to remind members of our audience you can submit questions. We encourage you to, and I will do my best to work them into my conversation with the gentleman you see on your screen. His name is Eric Peters. He is the CEO and founder of One River Asset Management and One River Digital Asset Management. And Eric, you made headlines last month as the Bitcoin whale who surfaced with $1 billion of crypto holdings and the backing of Brevin Howard's Alan Howard. And that, as we all know, is one sure way to make a splash. $1 billion, that was when Bitcoin was priced slightly lower. How much do you hold in crypto assets now?
Hey Eric, thanks for having me. And I would say that I would say we made headlines in that you broke the story. Yeah, we well in excess of $1 billion at this point.
Now you've written a manifesto, the case for digital assets, and that's where I'd like to begin, because since you emerged as the whale, Bitcoin has more than doubled to $40,000, and it has since pulled back about 25% to $31,000 as of this morning. The volatility is fine, I suppose, if you're a retail investor. What is the case for institutional investors to own digital assets now?
It's a good question, and look, our starting place is to think about what the right place to invest is, as opposed to what's the right place for institutional investors. And I think, you know, when an institution is looking at its portfolio, there's an issue of, you know, what's the appropriate size. But let's start with just the investment case. I think that you know, we are in a unique period right now. It's a very late cycle period that we've seen many times throughout history, and it's a period where governments become extremely indebted, monetary policy becomes less effective, and ultimately, governments, in order to spur real demand in the economy, need to issue lots of debt and begin actually spending. And typically when they do that, they try to unburden themselves from the debt that they're incurring by debasing the currency that they're issuing that debt in. And so it's a very rational response to an economy that is late cycle and heavily indebted. The issue there is that ultimately those who hold that currency, you know, lose their spending power, and it becomes a difficult difficult challenge to figure out how to at least hold on to that spending power. And there aren't that many assets in a world like we're in today, where things are so rich in terms of their pricing. Digital assets are really interesting in the sense that they're new. It's a new asset class altogether, and I think they have some unique qualities, part of which resemble the qualities that you'd find in gold, except that they're, I think, wildly underpriced relative to gold. And then they have another set of properties, which are properties that are technology properties. So Bitcoin, for instance, and this applies to other digital assets as well, but it's a technology platform, and it will look different tomorrow and next year and in a decade to come relative to how it looks right now. And that makes it unique to gold, because kind of gold has looked the same 2,000 or 2 billion years ago, and it will look the same in 2,000 and 2 billion years from now. The question is, what are these technology platforms, this new nature of money, what will that look like in 2 months and 2 years and 20 years? And I think, you'd have to be a real pessimist to think that an emerging technology platform doesn't become more interesting, more useful, more valuable. So this entire asset class has these unique properties in that it helps, it allows you to gain access to the possibilities that these new technology platforms hold, while also helping mitigate this risk of monetary debasement that's a function of kind of poor policy decisions that we've made in the past. And so it's very rare that you find an asset that can kind of allow you to capitalize on future upside while also mitigating the downside like that. So that's, I mean, we could spend a lot more time on it. I would encourage anyone to read, you call it a manifesto, it's paper. But I would encourage you to read that because I think it dives deeper into it. But at the core, that's really the argument.
Would you say, Eric, at the moment that your interest in or faith in digital assets has more to do with the first leg of the thesis, which I would call the macro leg of the thesis, or more to do with the second leg of the thesis, which is more about, the promise of technological innovation?
It really is a combination, Eric. But look, I've been a macro investor my entire career. I always start with the macro. I'm not at my core a technology investor. I've just watched the advance of technology over the course of my career. I've marveled at it. I think it continually astounds us in terms of where it leads us. And so I have seen a whole range of the emerging second layer applications that will be built upon this technology platform, and they're super promising. I've seen enough to know that in essence, tomorrow is going to look better than today. And I think when you're investing, it's incredibly important. Does tomorrow look better, worse, or the same? And I think I've seen enough to just understand that tomorrow looks better than today in these assets. But my starting point is really macro. And we have been anticipating this late cycle activity where we advance fiscal policy, we really expand it. I think this pandemic has created an expansion that's in excess of what we or almost anyone would have imagined possible. The fact that it's co-joined with monetary policy at this point, in the sense that we're issuing enormous amounts of debt and we're having our central bank buy them, that's the dynamic that we have been anticipating. It's the scale of it is just so profound that that's really that's the driver. So the question is, in that environment, what are the assets that you can own? You can try to own equities, and a lot of people do. Those have not done well. Typically in inflationary periods, look back at the 1970s and you'll see that. You can own gold. Gold is, a lot of people own gold. Or you can own digital assets. And I think if you believe the things that we have seen and believe, then you look at them and you go, these are dramatically undervalued relative to some of these other stores of value. And so that's what makes us excited about these. It's just an undervalued asset for that macro backdrop.
I don't need to tell you, Eric, that crypto skeptics are everywhere. There are many to choose from, but I'm going to go with Jeremy Grantham, the legendary value investor. As you know, he's not a macro guy, but he raises a couple of pertinent questions. One is, how can you value anything that generates no cash flow? And the second is, if Bitcoin is 100% faith, a quality, by the way, that you acknowledge in the manifesto, in a bear market when investors retreat to proven safety and faith is at a minimum, Grantham asks, who will want to own something whose entire reason for existence is faith and nothing but faith? How would you respond?
It's a fair question. Here's the thing. You don't get to buy a cheap asset unless there are all kinds of reasons to be skeptical. It just is. It's just a reality, right? So, we could spend a half an hour going through it. We could probably spend 3 hours going through the case to be not to be skeptical, but to be concerned about owning anything that doesn't yield a cash flow, right? At the same time, gold doesn't. There are no cash flows associated with gold, right? Gold is worth an awful lot of money. As are a whole bunch of different equities that yield no cash flow or negative cash flow. And so, look, I think in many respects, my goal is not to try to persuade people that this is a wonderful asset to own. I think we've done the analysis ourselves. I think in a world where there is abundance of all things, we have a unique asset here in Bitcoin, which is it has limited supply. It's unlike any asset that I've seen in the world, in the sense that there's no supply response to the price. So if Bitcoin went up 5 times in value, or 10 times, or 100 times, there wouldn't be more Bitcoin produced. You can't say that about really any other asset in the world. Now, does that mean that it has to go up? It doesn't. But if we have collective faith that this is a store of wealth for people globally, and it's a whole new type of store of wealth, in the sense that it relies on people throughout the world having a collective faith in its value, then it can become incredibly valuable. And right now, what I would say is if it were just to go up to the market cap of all the gold in the world, it would go up to something in the order of $500,000 per Bitcoin. Right now it's trading at, let's say, $30,000, right? So if you look at it from a trader's perspective, there's enormous convexity to the upside. I think it will be worth more than gold at some point because gold is not infinite. Gold continues to increase in terms of supply. Bitcoin supply will go down over time. And in the history of the world, there will only ever be 21 million Bitcoin. So, that's it. There are all kinds of fair criticisms, and he makes a fair one. From what I've seen, there's enormous faith that's being built up globally in ways that I haven't witnessed in my career.
Were Bitcoin to be worth more than gold, as you point out, it would have to go up 20x or almost 20x from where it is today. How long does it take for that trajectory to play out? Are we talking about a 5-year timeline, a 10-year timeline? What's your best guess at the very least?
So the answer is obviously no one knows that, and I think it's policy dependent. So I've been in this business long enough to know that you need to think in terms of probabilities. You need to try to imagine the various potential futures. I would say the probability of the U.S. reversing its policy of trying to debase the currency that it's issuing debt in, the probability of that is virtually zero. So in order to imagine that, you'd have to imagine an enormous economic boom that allowed the Fed to step away from buying treasuries and allowed the Treasury to stop issuing lots of debt. Okay, I think that's highly unlikely. I think more likely we could see some type of next recession that is followed by even more issuance and more buying from the Fed. Now, I think that the politicians and the policymakers think that they can proceed with this large issuance and monetization of debt and debasement in a very gradual way. And if they do that, I think that the value of anything that protects against inflation will go up at a relatively measured pace. I would say that if they're wrong that they can do this at a measured pace, and it becomes and markets become disjointed, and people begin to lose faith at kind of a faster pace than they would want them to, then these assets are extremely convex. It could happen in a relatively short time. It could happen in a number of years. In a matter of a few years. But one of the things about these assets is you have this optionality to the upside. It doesn't cost you anything to hold them. You have price risk to the downside, but you don't have negative carry.
Can digital assets, will they appeal to institutional investors if they continue to exist in what I would call a parallel track to fiat money? Or do institutional investors need to see some kind of government or central bank acceptance or endorsement, for, as Mike Novogratz would say, for the cavalry to really come in?
Well, I would say that you've borderline ruined my life after having broken that story, because the number of institutions that have been filling my day with calls and inquiries about this is astounding.
So it's happening already.
Yeah, oh yeah, enormously so. Now, I think this is if I had to guess, I would tell you that this asset class will become, let's call it mature, in a decade from now. That's just a guess, because I think what's happening is almost every big credible institution in the U.S. is having discussions about this at their IC. Many of them are calling us and asking, and typically if someone is calling us about our volatility products or our macro products, we'll have 3 people on a line. We have huge institutions where you have 10 to 15 people, the entire investment committee. They're fascinated by this. They should be, by the way, because this is the first and last asset class that will appear in our lifetime. And so if you're a large institutional investor, the first natural place to get exposure is the beta of these assets. And I think as One River as a fiduciary, our goal is to provide safe and secure kind of peace of mind around how institutions get access to the beta of these assets. But the beta of these assets is just the beginning. There are going to be all kinds of opportunities in this asset class, and so it's very important for all of these folks, whether they allocate a significant portion or some modest portion of their portfolio to these assets. It's important just because you get to start learning about them, and so we are overwhelmed with that type of response right now. So it's virtually impossible to imagine that you have this level of interest and you don't have allocations. But I think those allocations, they're literally going to take years, and they'll start small and they'll increase in size over the next decade.
I mentioned earlier your partnership with Alan Howard. He, of course, is a macro legend. He co-founded one of the world's best-known hedge funds, Brevan Howard. What is the story, Eric, behind your partnership with Alan Howard? How did the two of you come together?
Yeah, I mean, Alan's an amazing trader and investor and kind of business person too. I've known him for the last decade. We talk macro markets a lot, exchange ideas, information, et cetera. We kind of explored something a few years ago, potentially doing something together, and it just wasn't really the right time. And he called me this late summer and just said, I think it's time for us to restart those conversations. Aaron Landy is his CEO, so Aaron runs Brevan, and so we all discussed kind of the really, I mean, honestly, the best way that we can capitalize on the decade ahead, which we think will be extremely difficult for investors, and really bring the most value to our clients. And felt, One River is we're a macro firm at our heart, but we very much take a solutions-oriented approach to how we interact with our clients. So I'm a collaborator by nature, so we think a lot about how to work with our clients to help them think through their big problems and issues, and then deliver solutions to that, investment solutions to that. And Brevan is the greatest macro firm in the world, and so our view was collectively that we could be better firms if we work to collaborate and help our clients think through the issues and deliver solutions to them. So they took a 25% stake in October, and it's been, and there have been all kinds of things we've been able to do together. It's a wonderful partnership, and it's great to work with both Alan and Aaron. And I think Aaron's vision for Brevan looks much more solutions oriented or partnership oriented with their clients. So it's that's how it worked out, and it was great because it's nice to know people for a long period of time and then be in business with them.
This event is called The Year Ahead for a reason, because we want to look into the future, and we've been talking a fair bit about the future, but let's talk about the next year. A year from now, January 2022, Eric, what do you think this digital asset landscape will look like? What do you think Bitcoin will be trading at? What will have evolved in the way of infrastructure and appetite for digital assets?
Well, I think that prices will be higher. I think that there will continue to be volatility, but ironically, there are all kinds of reflexive dynamics in these assets that ironically will lead to less volatility the higher they go. In terms of the higher the price goes, because what you're doing is, as the prices are going higher, you're drawing in new types of investors with stronger hands, quite frankly. And so I think over the next year, a lot of money will be drawn into these assets, and that prices will be higher. There probably will be volatility in the sense that markets always try to get ahead of themselves, or they don't try to. They inevitably get ahead of themselves. I think there's a lot of expectation of institutional allocation of this space. That will happen. It absolutely will happen. I mean, we're building one of the on-ramps, and I think will be the leading on-ramp for institutions to get access to this space. And so I think we'll have a good pulse on what those flows look like over the next year, but they're absolutely coming. I think that the regulators they play an important part here, and from our work and discussions, I think that they're most interested in making sure that this digital asset kind of foundation is firm. So you'll continue to see regulations come out that try to increase the transparency in this whole asset class, and I think that that's a good thing. That will what's happening right now is you're seeing these regulations come in not to destroy this asset class, but to really make it a firm foundation, because regulators understand that the future of finance will be digital. And so if they were to somehow really damage this asset class, what they ultimately do is they harm the foundation for U.S. entrepreneurs to bring innovation to the space of digital assets. And we'll see that to our competitors and our adversaries, quite frankly. So I think we'll see more regulation. I think there'll be push and pull. It will be sensible, ultimately sensible regulation. And I think that will lead to more flows in this asset class. I think what you'll also see, the last thing I'd say is you'll see more second layer applications and things built around these assets that will start to really kind of tease people's imaginations about where this can go. And so, as I said, tomorrow in these assets, tomorrow looks better than today. And so in a year's time, you and I will be having a conversation like this, and you'll be asking questions about, hey, how about that payment system that was built on top of Bitcoin? What do you think about that? No one sees that yet, but they'll see, in a year we'll be talking about things like that.